Good morning, everyone, or good afternoon, or evening, or good night. It's Jackie here, Jackie Petite Home, with my wonderful partner, Julian DeLeonardo. Julian, how are you feeling?
Hey everyone, thank you for joining us today. We're going to tackle a couple topics ranging from volatility to the election, and we look forward to you listening.
Yes. So today is Thursday, August 8th, just in case you listed this a couple days, but we've had some volatility this week in particular. And I thought it might make sense for us to talk about it, but let's kind of review, Julian, like what's been happening this week and kind of catches up to what really made us decide to jump on and talk.
Perfect. So if you turned on CNBC this week, which I do not recommend, you would think the world is on fire, right? You would think everything is going terribly around the election, around international conflicts, right? The entire screen is red, and they certainly try and evoke some emotion. So I definitely recommend not turning that on. Maybe watch the Olympics, much more entertaining. But this week, essentially, markets open on Monday down slightly, 1 to 2%, depending on certain which index we're looking at. And when you really look at the whys, there were a few different components ranging from Warren Buffett selling Apple on Friday, about half his holding or so, I believe. But don't quote me on that. And the interest rates going up in Japan as well as the ongoing election and who's going to be vice president, things like that. Would you add anything to that? Is there anything you saw that also contributed?
I do think as well, I saw, which we'll touch on the election, is just like the election, we've had a pretty interesting developments in the election as well. So I think a lot of folks, as always, see to find reasons on why things are happening when sometimes, yes, things have an effect, but these are almost just, you know, you shouldn't be panicking, right? Like it's a lot going on. So I think we should talk a little bit about like the volatility and really what it means long term for people who are investing. And also, I'm going to ask you this, Julian, does investing during a election year be different from any other year? So I'll let you start wherever you want with that one.
Perfect. A few different things to consider, right? So when you look at this year specifically, this election year, it's actually been a year where there has been near minimal volatility up until about 2 weeks ago, right? So it was a pretty consistent year as far as fluctuations, all trading within a pretty reasonable range and being up, about 9% as of a few days ago, even after this recent fluctuation. So it has been a pretty level year overall, a pretty good year up to this point. So don't be nervous or scared about routine fluctuations. As far as an election years historically, there is minimal meaningful difference in the returns during an election year versus returns not during an election year. There tends to be more volatility, right? Because there's more stories, there's more narratives, there's more news, right? But the actual end result really ends up being essentially the same. Jay, you want to touch on what those numbers look like specifically? I think you have something to pull up as well.
Not only do I want to touch on those numbers, I'm going to share this chart. So for those of you who are watching on YouTube, so all 14 to 15 people, we appreciate you. We're going to share this chart as well, probably down the line, but it's something very, very good to look like. And it's basically the percentage of drawdowns here. So even though we've been using Zoom for years now, it's I'm looking to see if I can do this without messing up. So Julian, I'm going to quiz you on this. What percentage of years, you may know the answer, uh, does someone, or does the market, excuse me, draw down at least, let's say 5%?
I have been talking about it all week. So know the number, 94%, right? So 5% drawdowns very common. I would say 10% drawdowns also very common. I think that number is about 76% of the time. There's a 10% drawdown. A 20% drawdown is about a fourth of the time. It's every 4 years or so. And these are numbers that we talk about with a lot of the families we serve. It's very important to note, right? There are, similar to your day-to-day life, there are storms, right? Storms come along, but they always pass, right? They will pass in time. And you can't have all of the good of investing without the bad, right? Without the fluctuations. So the best thing to do, well, I'll pass the ball. Jacky, what do you say the best thing to do is?
Actually, the best thing to do, Julian, pardon me, technicals there, is to block out the noise, right? Ignore, you mentioned CNBC earlier, and we tell our families that we serve, hey, listen, if the news is telling you to panic, it's not because probably shouldn't, it's because they want your eyes still on that TV. But if you look at this, it's 94%, right? Good job, Julian. And also, I think what's also interesting are the other numbers. If you look at the 20% drawdown worth, that's 26. So 1 out of every 4 years, there's a 20% or worse drawdown. So it's expected. Volatility is the cost of admission, right? So keep your long-term vision in mind. And if you're someone where this short-term volatility is going to make you abandon your long-term investments, right? Then you should be having a more risk conversation totally, right? Not just, I can't do these like short-term market movements. Yeah, but what would you add anything to that? How did I do, Julian? What did you say?
It's important to note, and I say this a lot, for a lot of the families we serve, 50s and 60s, you've seen this before and you will see it again. If it's hitting every 4 years or so and you're 60, you've seen it 10 times, right? So you see it over and over again. It always feels new. But most of the work that can be done to alleviate the stress and invest for long term, at least for us, right? Because we are wealth managers and we are proactively working with our clients on financial plans. It has been done, right? When you're in the storm, right, it's oftentimes not the ideal time to dial back the risk, right? These things are going to come. So you want to make sure everything is in line with where it should be. You are diversified. You are comfortable with the amount of risk being taken. If you are not diversified, that's when a 20% drawdown hurts a lot more, right? Because if the market's down 20 and you're in a high beta position and you're down 30, it's much harder to feel comfortable and come back from just numerically, as opposed to if you are trading within a range that you're comfortable with and you're really focused on your long-term goals. One thing we do is we typically have a cash buffer for a lot of our new retirees. Jacky, you want to touch on what that typically looks like, and especially how impactful that was over the past couple years in 2022 specifically?
Yeah, that's a good point. We should mention that. And the folks who retire, right? The market volatility is obviously can feel more impactful. Those close to retirement or in retirement. And one thing that should be part of every financial plan is, what are we going to do when that drawdown occurs? Because it's not an if, it's a when. So for a lot of our families that retired over the last few years and preparing for retirement, we do what's called the bear market reserve. And the bear market reserve is, simply put, a reserve of cash for your bear market, which is 2 years of what your projected spending will be. Now, there's a lot of numbers and figures to figure out that is, but that helps you insulate your needs, right, when the market inevitably draws down. So in 2022, when the market had the 5th worst sell-off in 90 years, right, and every asset class was down, our clients were like, hey, you know what? This doesn't feel good, right? It doesn't mean you're just going to be, but I know I've got 2 years of spending before I even have to start considering what my stocks are doing. And traditionally, 2 years is a pretty good long amount of time for those stocks to recover.
Exactly. And it all goes back to that proactivity, where when you know you have that, and then rates climbed rapidly as well in the following months. So you were receiving 3, 4, 5% interest on your cash. You didn't have to sell anything, right? At an inopportune time, and you were well prepared. You had a ballast going forward. So much of what can be done should be done ahead of time. And then when there are times of volatility, it can be an optimal time to rebalance. And that's something we did for our clients on Monday, as we rebalance portfolios, trimming what's done well, buying a little bit of what hasn't done as well, and is a little bit better value right now, seeking that long-term growth over time, because things are cyclical, right? I think a lot of people talk right now specifically about the AI boom, right? What is AI going to do overall? So there's a lot of interest in technology stocks and what's hot in the streets, right? But when you really look at it, one thing that sort of went out of favor, at least as far as narratives go, is energy stocks. And if there's one thing that all of these massive computers need, it is power, right? If you look at the data, I don't have it in front of me, but it uses something like 10 times the amount of power as opposed to just a simple Google search. So there's a lot of different narratives going on. There's always things to focus on and things not to focus on. But the things to focus on are typically more boring, right? And that's typically what you see overall.
Yeah, and it's good for mentioning boring. There's a couple indicators I always know where the noise is really loud, and that's when my mom, hey mom, because she listens,
Yeah.
number one fan, asks me what's going on in the markets. My mom is 69, retired, hanging out down in Florida, living her best life, and when she calls me about the markets, I know it's permeating into everyone because she watches the news, but she's not concerned about that stuff. She's okay. So I'm actually going to pull this up. And there's a markets in turmoil chart. I don't know if you're aware of this, Julian, CNBC, and I'm going to quiz you again. So CNBC runs, it's called a segment called Markets in Turmoil. How many times, let's just throw out a number, let's say out of every 10, do you think that the markets truly had a long-term bad rate of return every time they said, markets are in turmoil?
I would imagine they run it when markets are down about 20%. I don't know what their specific trigger is. So just knowing that, I would say maybe 80 to 90% of the time it's up within, I would say, a year after it's up. Oh, wow. A little bit off.
Yeah, a little bit off, a lot, that's a good guess, But so if you're watching on YouTube, hey mom, again, if you look at the chart, right, I'm going to say for people listening, it's the S&P 500 for total returns following CNBC's Markets in Turmoil specials. And it goes back to 2010. And as you can see, if you look closer, we'll maybe share this too somehow. It's just all green 100% of the time. There's not one single red box. It shows a 1-year forward return and total returns since. So even if you go back to the very first entry, right, it's May 6, 2010, markets in turmoil, and the S&P was at 1128, right? And the 1-year return was 21%, and the total return since was 367%. That's insane.
Wow. And I think the takeaway there is when CNBC tells you to panic, that's the best time to not panic, right? Because they run this at times where people are concerned. And then immediately after, you see those upticks start to hit, and it's a good time to take advantage of them. Or at worst, right, just go outside and leave your computer at home.
Yeah, exactly. And it's one of those things too where there's Patrick Bet-David, who's like an entrepreneur. He had like a segment online somewhere, and he said, you always look at like how the person's trying to make money. What is their business model? And news business model, unfortunately, is not information anymore. It's panic and having people dialed in. So I have one more chart, Julian, but this is about the election years. But um, what, and you probably know this, folks, but is there a big difference long term for election year returns? And what would you comment about that?
There's not. It's something where a lot of times, right, based on your political party, there's desire to tag a narrative to, if so and so wins, we're in business. If so and so wins, we're screwed. But at the end of the day, right, if there's one thing Congress is, it's ineffective. So you know that regardless of who wins, things tend to not change all that much outside of essentially who's standing at the podium giving speeches. So when you look at it, it's important to note that it's another time to essentially block out the noise, right? And we do this every 4 years, where those narratives come up. If so and so wins, I'm going to Canada. Canada's doing much worse, I think, at least based on what I've seen. So when you look at it, it's best to just continue forward overall.
Very valid point. And for those who are just listening, I'm sharing another chart, a very heavy chart sharing day. I don't think we've actually even shared charts on any last episode, but it just shows the average annual return of election years, all years, and non-presidential election years. And essentially, the difference is a 0.5%. Presidential election years, the average annual return is 11%, and non-presidential are 11.6%. Now, some people might argue, is it because election year? Maybe, maybe not. Highly unlikely, but just to show it's marginal, so close that I've been saying this entire time. We've both been saying, block out the noise. There's always something that's going to say uncertainty, right? That's literally the heart of volatility, because everything feels new, but history rhymes, right? So there's always things that's going to be new, but we got to remember that long term, what's happening today, long term is where we are. You're investing in long term. If you're investing for your short-term trader, good luck, right? But what we do on our side of the table is investing for the families we serve and making sure that they're hitting those financial goals of theirs, regardless of what's going on today.
Exactly. And when you think about it, much like you're saying, there's always a reason to sell, right? If you really zoomed out and looked at the past decade or so, there were 40 different reasons, 40 different time periods where you would turn on CNBC and there would be a goal, right, to make you panic, right, and make you keep watching. But when you look at it, in what was it, 2012, S&P downgrades U.S. debt, then gold peaked. You had questions around the fiscal cliff. You had U.S. government shutdown in 2014, 2015. You had the Ebola virus, right? That was one that came up before COVID, right? That led to some drawdowns. Crude oil bottomed. Remember when oil went negative? That was another time that there was a lot of panic, alleviated relatively quickly. You had the trade war. You had U.S. stocks being flat for about 20 months at one point in 2018, 2019. Then you had the once in a century global pandemic, everything locked down, right? That was a time where people thought we were. My favorite was the Evergrande ship blocking the canal. So that was another one that led to a huge supply chain issue just because a ship got lodged in a canal in a place most people can't point out on a map.
That was one of my favorites, by the way. I completely forgot that happened.
Yes, exactly. Then you had inflation, much higher than the Fed expected. But again, all of these things come up. There's always a narrative. And if you really zoomed out and looked at your investing career, there have been an innumerable amount. And it's something that, frankly, you can't avoid. And there's always going to be another one coming up. With that, I would add Warren Buffett's sale of Apple doesn't need to be one of them. He is not a hedge fund trader. He is 93 years old. He has a stellar career. He is a superstar, obviously, at everything. But he is not necessarily someone that the average person should be seeking to be. because his entire situation is extremely different. And if he sells Apple at a high, right, essentially to create more cash for his situation, that's beneficial to him and great. But his timeline is different. He's running a different race than you are as an individual. And frankly, a lot of what's going on behind the scenes is they're investing insurance premiums. So they should have more cash than the average person. They may operate differently than the average person running the company that they are running. And it's just an entirely different story. I don't need to beat a dead horse, but I think it's bizarre when his stock essentially went through the roof since he bought it. He trimmed some profits. What's the problem? It doesn't have to be an indictment on the U.S. economy.
Yeah, and I think even though we all know Warren Buffett is the GOAT, one of the GOATs, we should also add, all the other successful entrepreneurs or investors who always would like to tweet some sort of thought about what's going on in the economy and what to do financially. Because one, they don't know what to talk about. Like Robert Kiyosaki has called for a great recession like every 6 months. And, like he wrote a good book back in the day, but he's not, the authority. So again, block out the noise. That means everyone, right? Listen to your professional, stick to your long-term goals. If you're a long-term investor, you should be invested in something that you believe you should be holding on for the next 5, 10, 20, 30 years. And just, just really think about the volatility you've been through. Because most folks that's been investing, we've all lived through 2022. We've lived through 2020. We've lived through 2008, right? And we don't know when the market's going to come back, but we do know that if you believe in, America and the stock market, right, and innovation, that it comes back, and it's just having that patience and making sure that you are allocated appropriately, right? If you're retirement, that bear market reserve, or if you're not retired yet and you have an emergency fund and you have cash on hand, where if you're going to buy your first home next year, that shouldn't be in the market either, right? So I think that's something as well that people panic on when they thought they could get a quick gain in the market because they need to make a purchase in a year or two. And of course, the market moves against them.
Exactly. So it's always important to note somebody's running a different race than you. We're all at different stages of things. If you are not running a multinational corporation, you don't have to be doing the same things. So just always take note of what your specific situation looks like. And the last thing I would add is not to get sucked into the dollar amount focus on the total amount, right? Because a lot of the focus this week and with this stock sale was that they have something like 200 billion of cash right now. So that's much more than I think most people have. But they fail to recognize how large the overall portfolio is. He might have 400, 500 billion dollars invested, and I don't have the number in front of me, but it's very, very different. And when you open the journal, when you read online, they never acknowledge that, especially in the title. The title always strictly states the numerator in this situation as opposed to incorporate the denominator, and really giving context, right? I think that's what it all comes down to, is the lack of context when you see these things.
Very valid point. I do remember that as well. That was something a few folks that I know sent me that article in particular. It said, oh, they raised hundreds of billions of cash. You're like, oh, what does this mean? I'm like, nothing. How are you doing? Like, what are you doing this weekend? Let's talk about that. Right. Don't be concerned. Yeah. But at the end of the day, sum it down, right? Focus on your long-term goals. Make sure your portfolio is diversified and matches, right, what your long-term goals are, and work with your professional, and make sure you have someone in your corner to help you navigate, these waters, because it is election cycle. And I forget what time of the year, but we are approaching historically the 10 worst days of the year, volatility wise, just historically. But again, if you've been listening to anything we've been saying over and over again, different ways, it's just block out that noise. So Julian, before we sign off, anything you want to add or anything to sign off
One more data point. Monday, when there
on?
was, I would call a minor fluctuation. It gets forgotten that during COVID, the market was fluctuating 5 to 12% a day, right? So 2 to 3 is nothing, and very normal. Data point on Monday, institutions were net buyers. I think I saw something where they were buying 14 billion worth of securities, stocks and whatnot. And retail investors were net sellers, and they sold $1 billion worth. So that's from JP Morgan. I'll include the link in the bio, but stay cool, right? And that's something that institutions typically have as an advantage over individuals. So they tend to be more long-term oriented.
That's a good point to bring up. And I will sign off on this Warren Buffett quote. So we've been talking about him. Be greedy when other people are fearful, and be fearful when other people are greedy, right? That pretty much sums it up. So everyone, thanks for listening. If you have any questions for us, please don't hesitate to reach out. Anything you want us to address as headlines will be come across your desk on the day-to-day. And yeah, this is Jacky and Guilian, Inevitable Wealth. And have a good day or evening.
Yep. Thanks for joining us. Stay cool, both mentally, physically. Get out there, enjoy.